Welcome to this webinar series of Barjeel Geojit that we have been doing every Saturday over the last 5 weeks now. And every week we strive to bring a well-renowned speaker from India to talk to us on the Indian markets. So over the weeks, we've also seen how the market behavior have progressed. We started with a total crisis mode somewhere in the middle of March, and then we had this lockdown, and then we had a total lockdown, and then we had in terms of a recovery that happened in the markets. And now we are moving to it as we speak. This week, we are in a process of a partial opening of certain business sectors in India and the prospect of opening up in the next 1 or 2 weeks. These are things that are happening not only in India, but also globally as well. And today we are indeed privileged to have Mr. Navneet Munot, the Executive Director and Chief Investment Officer of SBI Funds Management. Mr. Navneet, to many of our clients, needs no introduction. He's been a regular visitor to Dubai, and he has been spoken to a number of our meetings over the last many years. As just to quickly introduce Mr. Navneet. Mr. Navneet is the Chief Investment Officer of SBI Funds Management. He has over 25 years of rich experience in financial markets. In his role, Mr. Navneet is responsible for overseeing investments worth over $100 billion across various asset classes in mutual fund and segregated accounts. In his previous assignment, he was the Executive Director head multi-strategy boutique with Morgan Stanley Investment Management. He is also the chairman of the Indian Association of Investment Indian Association of Investment Professional, CFA charter holder with over 2,000 members. He is a postgraduate in accountancy, business statistics, and a qualified chartered accountant. He is also a charter holder of the CFA Institute and the CAJA Institute. He has also done his FRM. I think the credentials speak for himself. Before I request Mr. Navneet to start over, I would also like to inform him that we also have our clients from our joint venture from Muscat QBG Geojit who are also on this call. And I'll thank you, Mr. Navneet, for joining us today on this webinar, and over to you.
Thank you so much, and it's my pleasure, absolutely, to be with all of you today. As Krishnan rightly mentioned that I may have met several of you over the years, but the world has changed so dramatically now that everybody has to meet virtually. The in-person meetings, we are all keeping our fingers crossed. I don't know when is the next time we'll be able to meet in person. But I always say that constraint is the mother of all invention. And the constraint that this crisis has brought in is leading to some very interesting innovations, is leading to a lot of interesting kind of new things that we are doing. So as Krishnan mentioned that you have been doing it every Saturday and bringing some experts from some part of the world. I think had this crisis not been there, we wouldn't have thought about it. So while there are some negatives, there are always certain positives from every crisis, and that's the human ingenuity. We all keep our hopes on. A crisis like this has never happened in our lifetime or even in the lifetime of our parents. We have seen all kinds of different crises, from natural calamities to economic shocks to recessions to market shocks, etc. But something like this has never happened. People have to go back to a Spanish influenza of the last century, more than 100 years back, to see what really happened. But that time the world was quite different than the world which we are in today. I mean, the world wasn't as interlinked, as interconnected, as interdependent as it was, as it is today. It wasn't the case 100 years back. And this crisis, again, to put it in the economic perspective, I'm sure everybody knows that IMF, which at the beginning of the year mentioned that in 2020, global GDP growth is likely to be 3.3%, is now talking about a 3% recession, a 3% degrowth in global GDP. And most likely, they are saying that these numbers may have to be revised downwards. We had the first quarter GDP data of China, a country where the crisis originated. The GDP growth came at -6.8%. And remember one thing, all parts of China wasn't closed. I mean, there were parts of China which were operating well in the first quarter, and despite that, they had a 6.8% GDP decline. This year, at least 170, 180 countries in the world will have a decline in per capita GDP of their countries. So it's a massive shock to the global economy. There is a demand shock, there is a supply shock. Even if somebody wants to supply and wants to produce, they cannot. Even if you want to consume, you cannot move out of your home. And I'll also talk a little bit about the oil shock. Sitting in Middle East, you know a lot better about the oil dynamics than I know. But I'll talk about it in a different context a little later. So it's a massive shock, and the world wasn't prepared for it. I mean, if you look at the direction of the market in February, everybody can clearly say that the world wasn't prepared for it. Otherwise, the kind of volatility and the kind of sharp fall that we saw in the month of March wouldn't have happened if world could have anticipated even a little bit of what has really got unleashed. And that's why globally, I'll try to keep it short so that we have more time for Q&A. And that's why the policymakers also reacted in an absolutely unusual and in an extraordinary manner. The way US Federal Reserve printed money, in last 2 months, they have printed more amount of money or have bought more securities than what they did after 1 year of global financial crisis, which was like such a massive crisis. So you can imagine the magnitude, and that's the case with almost all central banks in the world. It just shows the pace and the ferocity with which all the central banks have reacted. Same is with fiscal policy. I mean, US is more than now 10% of GDP. Japan is like 20% of GDP. Every country is announcing that. And my sense is that it's only going to increase over the next few months because the economic shock is going to be much deeper than what anybody can anticipate at this point in time. Of course, it's been 2 months. And one of the good part now that in last 2 months, now the world is gradually coming to terms with this crisis. At the beginning of this crisis, people were generally in denial, and that's the reason the kind of casualties we have seen, and even in developed countries of, let's say in Europe or US and all, because initially people were, I mean, if I can use a very strong word, were in a denial of the magnitude of the crisis. But the last couple of weeks has given the world some time to really prepare for it. Initially, social distancing was the only way to contain the crisis. Do as many tests as possible, trace the people, isolate them. I think that was the way. And I've also been saying for last 2 months that, in fact, drawing on a study of which was done for the Spanish influenza in 1918, that in United States in that year, which was like a really a very, very big crisis, the Spanish influenza, where large number of, I mean, probably historically, I mean, one of the largest number of casualties in human lives that humanity had seen, that the cities that had a lockdown earlier and longer, they ultimately came out better, both from the health crisis as well as from the economic crisis. And that's why I mentioned that I think any country which is following a stricter lockdown will come out better, and there are clear examples. But after 2 months, there are clear signs that whether in terms of a medication or a vaccine, to really have a breakthrough, it will take some time. And now I think probably the public discourse, this is my view, that will start moving towards from survival only to revival also. How do we learn to live with it? And to me, I think a bigger innovation now has to happen on preventive care, on sanitization, on disinfection, and trying to identify ways to live with it so that economic activity can come back to normalcy, or to go back to where we were a few months back. We will not be able to go back to where we were, but at least keeping complete shutdown for an extended period will have its own consequences. Now, just to talk about it, how I think about this preventive care. So when air travel started, there were a lot of risks. There used to be a lot of accidents. Over the years, the airline industry and everybody started thinking about ways to contain the accidents. And now you see maybe a 1 or 2 accident and millions of flights that take place every year. Same thing about the road travel. It's very risky, but then we have put better roads, better signals, better lighting. I mean, the traffic cop, you need a license if you are driving, seat belts, airbags, so on and so forth. And that's how we have contained the risk there. And I think here also we'll have to think hard as a society that the people who are old and vulnerable, particularly those who have a certain disease and who are more at risk, if as a social, politically, all of us put our head together, how do we secure them so that rest of the population can come back to normalcy? My view is that public discourse will start moving towards that. Coming back to the markets, I think from a global markets perspective, we had a sharp drawdown in March. I mean, extreme volatility, which I mean, we have never seen in last 30, 40 years, the kind of volatility and the drawdown that we had in the month of March. But we had a sharp recovery in April from a lower prices. What led to that recovery? To me, three things. Number one, the belief in human ingenuity that I think we'll start learning to live with this crisis. There is going to be some breakthrough on medication or maybe vaccine or something. Second is the amount of liquidity that has been unleashed in the world, both by central banks and the governments everywhere. And the third is the pace at which markets fell. The valuations became quite attractive, particularly relative to the bond yields, because bond yields have fallen so much. So then, I mean, there was demand for equities at lower prices. Now markets have gone up. Where do we go from here? To me, to turn bullish on emerging markets, I want to see two or three things. Number one, I want to see US dollar peaking. Still US dollar and US treasuries remain the safe haven. Everybody's flocking towards them, which shows still there is deflationary impulse in the world. People are very, very cautious. For someone to turn very bullish on emerging markets, you want to see dollar stop rising and USD yields, I think, stop falling. The third thing I'm looking for is a stabilization in commodity prices. While everybody, I'm sure all experts would have told you that lower oil prices is a great boon for countries like India. We are a large importer. I believe that. I mean, a $1 fall in per barrel price is like a $1.5 billion of saving for the country, massive saving, no doubt about it. But oil has several dimensions. Sitting in Middle East, you know far better than me. I mean, the petrodollar generations will get impacted, particularly for India. Even the remittances there's another dimension to it. But from a global market perspective, for stability of credit markets, is important that oil stabilizes, because several economies would be in trouble, and that will not be good for the financial markets globally. So I think those are the signs one would be watching for turning a lot more bullish on the emerging markets at some point in time. But I still think that the amount of money that central banks have pumped in, they have provided at least, I think, a near-term stability to the financial markets. What we have to see is how, in which manner the governments globally spend the money. And to me, 2020 would be the tipping point, and I had this view even before this crisis, by the way. The 2020 would be that tipping point where governments globally will take charge and say that beyond a point, cheap money by central banks, beyond a point, zero or negative interest rates cannot get growth back. Growth will come when governments take the mantle in their hand and they start investing. Even the tax cuts won't help, because people are going to be very cautious now. Even if you give a tax cut, people will save more money. The way to get growth back in 2020, 21, 22 and beyond is governments world over will have to spend money on infrastructure. Social infrastructure, which is healthcare, education, so on and so forth. Digital infrastructure, clearly, I mean, the world is now working from home. We have to work a lot more on how do we ensure that without physical movement, the world can function. And the third is physical infrastructure. And to me, I think US will do it, Germany will do it, a lot of other countries in the world will do it. That's the only way to create jobs. I give you just one data point. In the last 2 months, the number of people who have filed for unemployment or jobless claims in US are more than the number of people who got a new job in the last 11 years in the United States. I mean, that's the magnitude of the damage on the employment front. And that's the case everywhere in the world. You may have seen some data points coming in from India also about the unemployment. How will employment get generated? Because private sector is going to be very cautious. Governments will have to spend money to create more and more jobs. To me, I think that will provide the way for a more sustainable growth. Now I come to India. We can discuss more in detail if you have interest on any other part of the world or the global markets. I'll just mention one more thing about the global markets. While I told you that for next couple of quarters or years, central banks and government together will try their best to keep interest rates as low as possible. They will try to repress the savers so that you have negative real rates and savers will have to pay a price for that. But at some point in time, if my view is right, that governments will keep borrowing money and keep spending, at some point in time, this should lead to increase in the global bond yields. I'm not saying it will happen in next few months. I'm not saying in next 2 quarters, but at some point in time, the 40-year-old bull market in global bonds is likely to come to an end. I don't know the tipping point, but the bond market rally, which started in early 1980s in United States, where interest rates used to be 15-16%, it has come down now to probably close to 0% everywhere. I think we are going to see a reversal at some point in time. I'm not saying you go and short the bonds, because I think central banks are so powerful, at least in the interim. That's a more longer term call you need to keep in back of your mind. Now, coming to India, if I put India on a chart of stringency of the lockdown versus the stimulus to provide the economic support, India is right at the top on stringency of the lockdown. That's why so far the damage on health is limited. The damage on human casualties is relatively lesser. If you see the size of the 1.35 billion people in a country like us and the infrastructure that we had for the testing, etc. If you compare that, India has so far done reasonably well, keeping our fingers crossed. We'll have to wait and watch how this kind of pans out over the next few days, few weeks. India is getting into a very, very crucial period of next few weeks, and we'll have to wait and watch. But so far, India has done well. But India has spent less money on economic stimulus, and that's why there is a deeper economic impact. So stimulus has helped us in containing the health damage. The stringency has helped us in containing the economic damage. The stimulus is less, and we are hoping that more will come to help us on containing the economic damage. Now, the only challenge is if the economic stimulus is late and delayed, then there could be a lot of challenges on the private sector investment, their confidence and spending, so on and so forth. I'll just add one line on the stringency on the health side. I think this is underestimated in the world today, but I'm sure if India comes out well from this crisis, 1.3 billion people, such a poor country with $2,000 per capita and the kind of infrastructure, most of you are from India, where we are in the world related to the rest of the world. The way India has handled this crisis with central government, state government, local government, healthcare, private sector, public sector, NGOs, communities, everything is absolutely phenomenal. The social capital that India is building in this crisis is absolutely invaluable. It's very difficult to put an economic value to it. We'll only know in few years' time the amount of social capital that India has built and the way everybody together. I don't want to spend too much of time on that. I'm sure everybody is reading about it. You look at the innovations that are happening in every state. What Kerala is doing, what Rajasthan is doing, what different states are doing is absolutely amazing innovations that are happening because we are definitely a low income country and we have to rely on whatever we can do in this crisis. Coming to the stimulus, RBI has done a lot. They have printed a lot of money, but the challenge is that they are trying to push all of that money through the banking system. And banking system is very risk averse looking at the environment. They were already very risk averse before this crisis. Now they have turned that's the challenge on that front, that RBI is pumping a lot of liquidity in the system, but it's not reaching the people who really need the money. They will have to do a lot more, but credit to RBI, they are willing, they are prepared. Every time, I always mention this, in central banking, what they do is less important. How they say it is a lot more important. And RBI is using a very strong language. You remember Mario Draghi of ECB when he said, whatever it takes. And those three words saved the euro, not the trillions of dollars that he printed. Shaktikant Das is doing something very, very similar, that we will do whatever it takes. The money that we have unleashed is only to begin with. We are prepared to put any amount of money in the system, which is like a great news. But they will have to get a lot more bolder along with the government to ensure that maybe like US, You look at US Fed, they are buying treasuries, they are buying corporate bonds, they are buying commercial papers, they are buying junk bonds, they are buying ABS, they are buying MBS, they are buying like every possible things. There are redemptions in bond funds, so they are buying bond funds. I mean, they are pumping in money left, center, and right. India cannot do that. We have always been a very conservative country. We don't have a luxury of having a safe haven or a reserve currency of the world. We have to be cautious, but we have to be a lot more bolder than where we are. On the government stimulus, everybody has been waiting and watching. The first set of stimulus was more like a social stimulus. 1.7 lakh crore rupees was to provide food and giving money to the absolutely bottom of the pyramid. That was a thing that had to be done. But now we have to put a lot more money to ensure that businesses survive, because a lot of businesses will have what I call a P&L recession. Next few months, you have no revenues, but you have to pay salaries, you have to pay rents, you have to pay interest, you have to pay your utility bills, so much and so much. In that scenario, how do you kind of give the confidence to the private sector not to save even more money, not to cut the headcounts? So government has to put a lot of money in the system. The government has to inject a lot of confidence in the system that we stand ready to spend money so that economy does not fall into a deeper recession. I mean, I can just discuss one or two. If you have interest, I can discuss a lot more about what needs to be done on the stimulus front. For example, can we substantially increase the money in NREGA in some or the other form and employ people to create some capital assets, build roads, build the urban infrastructure, build some wells, build various kinds of infrastructure, so that employment gets generated, people will have the money in their pocket, they will immediately spend, it will help the consumption, and an asset will get created which will help us over a long period of time. And by doing all of this, this is my view that over a period of time, the economic damage can be contained. And India has a lot of structural advantages. There is going to be and I'll just maybe list 2 or 3 of them, and then we open up for questions a little bit on the markets. There are certain structural advantages to India. Number one, I'm sure a lot has already been discussed about it. I'm sure all of you know about it, that everybody has been talking about it. There is going to be so much animosity towards China. And it's already becoming more and more, visible. I mean, if you listen to Mike Pompeo or Trump in US or some of the other countries in Europe, everybody is getting very, very, suspicious about China. India could be a structural beneficiary of that as large number of companies start investing outside China. India could be a beneficiary. Now, it is not our birthright that every company will come to India, but we have a large market. We have a large pool of labor supply. We have put in a lot of efforts, including a lower corporate tax, lower dividend distribution tax, so on and so forth. And with all of that, there is a possibility India grabs a share, and then it helps India in terms of FDI flows. Another advantage, India has a big pharma industry, healthcare industry, where world over, trillions of dollars will get spent on healthcare. India could be a beneficiary of that. There could be another Y2K movement for India. If you remember how India's IT industry became so big, when 31st December 99, and then the world had a problem with the computers, and India provided a solution in terms of coding to larger companies in the world. Maybe there could be another movement for India when healthcare spending increases, and even globally, every government, every organization, individuals will spend a lot more money on digital technology. India can grab a piece of that. And in that context, I must mention about the deal that has happened recently. Now, don't get me wrong. This is not a view on that stock. This is not a view on that company. This is not a view about that deal, the merits or demerits of it. The point I want to make it, if a large Silicon Valley company is putting in billions of dollars of investment in a technology platform in India, it just shows the potential of India's digital economy. Per capita data consumption of India today is higher than United States. Per capita data consumption of India is higher than United States. It's even higher than China. And think about it, India can really leapfrog from a data poor society to a data rich society. E-education, e-healthcare, e-governance, e-payment, e-commerce. I mean, I've argued, why not even e-judiciary now? I mean, why courts have to be only physical? A lot of things can be done digitally to improve our judicial structure, e-governance. I mean, think about it, India can really come back as a big digital powerhouse of the world, and next generation be can be in India, like we created large software services companies. And the third, as I mentioned, that there's going to be a lot of physical infrastructure investment next year in the world. I think India can also benefit a little bit from it. One or two other advantages for India: the rural economy so far, I won't use a strong word like is insulated from this crisis, but is less impacted. The problem we are seeing in Corona crisis as of now is more an urban phenomena. Bombay has a big problem, Ahmedabad has a big problem, Jaipur has a problem. I think some of the large Delhi has a problem. But so far, unless the migrant labor which goes and if it creates even problem in rural India, keep our fingers crossed. This is an auspicious month of Ramadan. I'm sure the Almighty is watching all of us, and He'll provide their blessing to the country. If the rural economy remains well, we had a good monsoon, food prices are good, supply chain is working now, government is working very hard on the harvesting of the crop. Gold prices have gone up so much in last few years, so there is a positive wealth effect. They don't have so much of money in the stock market. They have not seen a negative wealth effect. And with so much of investment that has happened in the more road connectivity, more digital connectivity, more banking connectivity, more electricity connectivity over the last few years, and all the LPG cylinders plus the Swachh Bharat toilets are there. The overall productivity and the connectivity has improved. There's a possibility that rural economy comes out better from it, and when we are investing, we are looking at who could be a beneficiary of that. So I can list few more. While there is a big crisis globally, India will not remain insulated. We have a lot of challenges in our financial system. The stimulus in India has been relatively lower than most of the other parts of the world. And because of that, we'll have to wait and watch from a market and investing perspective. But India has certain inherent advantages, and I'm sure society will rise to the occasion, not only the government and policymaker, but in terms of administration, judiciary, business community, overall society, to grab this opportunity. I have a strong view. This is like one of the biggest opportunity that could come for India. There was something similar in 2009. Somehow we couldn't take full advantage of it because India did not have a subprime. Our financial system was strong. We could have come out much stronger. We didn't do as well over the next maybe several years. I think today there is a big opportunity for India, where India, given its domestic demand, domestic demographics, the digitalization that is happening in India, the kind of labor pool, as I said, the skilled, semi-skilled, unskilled we have. I think there is a big opportunity for India, and I hope it turns out to be a good India's movement. But of course, as I mentioned, there are a lot of risks on the horizon. Now, from an investing perspective, as I mentioned earlier, just like the global markets, Indian markets fell very sharply, 40%. In fact, India underperformed emerging markets, and most of the other markets, we fell much sharper. And then we have risen also sharply. So we're still down like 20-25% from the peak that we had in February. That's one way to look at it. 20-25% higher from the bottom. That's another way to look at it. How are we looking at it? When the markets fell in the month of March and early April, we were like very, very excited, because at that point in time, valuations became cheaper, not only compared to the 2016 lows, not only the 2013 low where we saw Nifty bottoming at, like, I remember 4,800 or so in August, September 2013, but they touched almost the lowest point of even 2008 crisis. And there, the stocks became like very, very cheap. After that, markets have run up. But if you see the market run up, it's because of certain number of stocks which have gone up like very, very sharply. There are still a lot of opportunities in the market. So to put it simply, when I discuss with my team, all of them say we are feeling very anxiously excited about the situation today. We are anxious, just like each one of you. Everybody's so anxious. We don't know there is going to be a second wave, or is there going to be a third wave. If you go to Spanish influenza, by the way, it was not the first wave. The first wave was, a lot of people were lost their lives, but then people came back to normalcy very soon. And that normalcy hit the world very hard. And the second wave was where it was like very, very lethal. So we'll have to wait and watch. I hope that science, technology, interconnectedness of the world is better. In fact, as I mentioned earlier, while a lot of work is going on medication, on vaccine, on antibody kits, on testing kits, infrastructure, and so on, my view is that the world needs to innovate a lot more on protective gear, and how we can sanitize ourselves, disinfect ourselves, and and can easily live with this. I gave you the analogy of road travel and how the auto industry and governments and all of have worked together to make it safer. Something similar we have to do. But uncertainty is there. Uncertainty on health crisis, uncertainty on how effective the stimulus will be, uncertainty on the near-term impact on the economy, how many businesses will survive or not survive, and uncertainty on the longer-term implications of this. As I mentioned, what happens when so much of borrowing globally governments will do on the interest rates? What happens to consumer behavior after this? What happens to companies' behavior after this? In what form government's kind of policies will get unleashed after this? So there's a lot of uncertainty. But we know, I mean, we have faith on human ingenuity. Of course, this crisis is much bigger than what we have seen in our 30-year career. But at the same time, I mean, we know that from every crisis, we bounce back. In fact, deeper the crisis, bounce back is always deeper, because I always mention this. Reforms don't happen out of conviction. Deeper reforms happen out of compulsion. As the deeper the reform, as the deeper the problem, you'll see bigger reforms coming in, and the mankind will rise to the occasion, and then we'll come out of this the crisis even swifter and come out stronger. And that's why the businesses that have resilience, businesses that have balance sheet in a good shape, and particularly the businesses who are investing in right kind of technology today, because there are going to be a lot of technological disruptions in the world. There are going to be a lot of digital disruptions in the world. There are going to be a lot of disruptions in the consumer behavior going forward. There are going to be a lot of disruptions in the government's behavior, the policymakers' behavior towards citizens, towards several things. And companies that are very nimble, companies that are very agile, it's the adaptability of the company and not whether it's a large cap or a mid cap or a small cap. I'm not going to look at that. My team is not looking at that. My team is looking whether the management is preparing itself to bounce back sharply after the crisis over, whether the management has the wherewithal today in terms of their balance sheet, their capital position, their operations, their technological preparedness, and investing in right things, that they can come out stronger. If you identify those stocks, I think you'll make decent money over the next several years. You have to just wait and watch and then go through this period of uncertainty. I'll take 2 more minutes on the bond yields. Our view has been very positive on the bonds. We have been running long duration. We have always been very cautious on credit side. We continue to remain cautious in the very near term. I'm sure, I mean, in some other form, not in a T+1 liability format of credit funds, but at some point in time, there is going to be a very big opportunity in the credit markets in India. I mean, rates will be so attractive, high quality of collateral, high quality of covenants, but the T+1 liability is not a good format. I think you should invest in an AIF format, a good special situations fund, which draws down money over a period of time and invest with the right kind of care and long-term perspective. There's going to be opportunity on the credit side, but near-term, cautious on the credit side, but duration will remain positive. Last evening, government announced a massive increase in the borrowing program. Yields will open up maybe 30, 40, I don't know, 50 basis point higher on Monday. But I hope RBI will announce something on Monday or before Monday to ensure that yields don't go up so much. India needs lower interest rates. And I think if yields go up substantially in next 1 or 2 days, with the lack of RBI announcement, then that could be a good opportunity to put money in fixed income also. Gilt fund, corporate bond fund, which invest in high quality instruments, banking and PSU debt fund, which invest in only banking sector and good banks and in good quality PSU debt, etc. That could also be a good opportunity. Otherwise, the multi-cap funds where an opportunity to invest across sectors. I'm not giving you a view that market will not fall. Market has already seen the bottom. It will keep going up. Problem is behind us. Nobody really knows. I'm giving a very honest answer. Nobody really knows about this health crisis. We are learning every day. The longer term impact of economy, nobody knows. What we know is that having seen variety of these crises over the years, that we always bounce back. If you buy the right kind of companies at right valuation, run by the right management, you make decent money. Over the next few months is a good opportunity looking at India's strength to keep investing in India with a longer term perspective, not to take a very short term view on the market, but from a longer term perspective. If you have a 3-5 year perspective, all our models suggest that valuations will be where I think you can expect a very decent return over the next 3 or 5 years from Indian markets. But I mean, how low it can go, all I can say is it is likely to remain very volatile in the near term. Try, the last message I want to leave with you, 2 lines. Try to take advantage of this volatility. Don't don't get swayed by this volatility. Volatility can always be used in two manners. Either you get swayed by that noise, make mistakes, and damage your long-term financial goals, or try to take advantage of that, remain very disciplined, remain focused on your goals. And in that case, the role of advisor is never more important than what it is today. You guys are in good hand with all the advisors in Barjeel. I'm sure everybody is fortunate for that. And I think ensure that you don't deviate from that goal and from that discipline. On that note, I'll be very happy to take any questions that you may have.
Dilemma that an
Krishna,
investor.
sorry.
Yeah. And thank you for covering all the matters in a very concise form, and also pointing out the points that investors should look at this point in terms of managing their investment portfolio. So there are a number of questions that are coming in and flowing. So I would request people to use the Q&A icon to ask for questions. I'll try and consolidate, because a lot of them are repetitive or similar questions. I will try and consolidate all together and ask Mr. Navneet. To start with, let me ask a very generic question that keeps coming all the time in all our webinars and sessions that happens is, one is, what is your view on gold? Because that asset class has been probably glittering this year. And the second is on the INR, we saw a huge correction on the rupee, and now there seems to be a strengthening. With such low oil prices, and the sort of I know the fact is also exports are less. So why do you see both these performing in terms of gold and in terms of the rupee?
Sure. So first, in terms of gold, and as I mentioned earlier, that the amount of money printing which is happening, and central banks and government everywhere will keep the financial repression. Financial repression is where you keep forcing, more and more debt, and keep the real rates negative. When real rates are negative, there's a possibility that investors start looking at real assets like gold. There is a possibility that at some point in time, if this kind of money printing continues, people start questioning about the fiat currencies. At some point in time, people look for like alternatives to the treasuries and other things, and then automatically I think gold will have a lot of investment demand. We have already seen in last few weeks, I think, people's attraction towards the gold, and it can continue to increase in times to come. That's one asset class you should have a small allocation. Over the last few years, central banks also have been a large buyer of gold. It's early. I don't really know that whether they'll be worried about the currency depreciation would increase allocation to gold. The other way to look at it is every central bank would like to utilize the money today in something else, buying equities and bonds and treasuries and all. Would not like to buy more gold from the world. So there could be some selling actually from the central banks in the world. Physical demand may go down a little bit from India, China, etc. who are large physical buyers. But even if I put all of this in context, some of the negative and positive factors, likely that gold goes up from here on. Now you should keep one thing in mind: gold is just a hedge in the portfolio. Gold is an asset class which is not productive. It does not earn any return. It works on a very lighter note, a bigger fool theory, that somebody will pay a higher price to you for the same piece of lump which is there in your vault. And for that, it should be a small part of the portfolio because it doesn't give you a coupon, it doesn't give you an earning growth like equity, but it's a good hedge to have in the portfolio. If something goes completely wrong in the world, the economies get damaged so much that central banks keep printing more and more money, people will lose faith in the currency and they will buy gold. So for that scenario, to hedge that scenario, have some money into the gold. The second view on the currency, my view is that India is relatively in good shape, unlike some of the earlier crises that we have handled, right from 91 to Asian crisis to 2008 to 2013, from a foreign exchange reserves perspective. When we started the crisis, we were at like $480 billion of reserves, almost 11 to 12 months of import. My view is imports will fall very sharply. Lower oil prices will help. There'll be some negative impact, remittances, etc. But even then, I think from a forex perspective, India is in a good hand today. And with that, I think I don't expect rupee to really fall sharply from here on. So far, we have done very well. I think we have fallen much lesser than most of the other emerging markets, which are more vulnerable. In fact, it won't be too bad if rupee depreciates a little bit from here on. In fact, my view is that RBI should use FX reserves more boldly and creatively. I've been advising that, advocating, not advocating that why don't we buy crude oil from our foreign exchange reserves, maybe create wealth in India, create jobs and buy in forward market. And when the wells get ready, take the physical delivery. In India, we can create some equity fund or a debt fund from that forex reserves and all. But I think we are in a good shape. So you should be a little bit worried. I mean, if the dollar remains strong, rupee will also fall. But relatively, India is in a better shape compared to some of the other emerging markets.
Thank you. We also saw.
I think it's not a bad idea to have, even like, I'm sure each one of you benefited a lot from those Millennium India bonds, and then, you know, the Resurgent India bonds. I don't know, maybe something like that can come if situation deteriorates.
Yeah, I'm sure. I think the NRI community has been eagerly looking forward to such bonds fund, but unfortunately,
yeah,
even though the government,
every time you guys made like so much of money every time.
I know. Another macro factor has been that we have seen large outflows of FIIs, close to $10 billion in the last 3-4 months. And suddenly, when you see the May data, we are seeing quite close to $1 billion plus flow has already happened into the markets, whereas domestic flows seem to have had a small setback in the month of April. How do you see the FII behavior? Do you think these are more sustainable flows that will come forward, or do you find them to be more erratic in the near term?
So from a foreigner's perspective, I mean, the first round, I mean, there was a very sharp selling. Emerging market funds, the bond funds got, if I remember correctly, between the bond and equity funds, lost $75+ billion of outflow after the crisis broke out in March. A massive outflow, a record outflow from emerging market equity and bond fund. All of those guys had to sell everything, including India also, and India also bore the brunt of the FII outflow. But as I mentioned, that the valuations became attractive, and then some of them have also started nibbling in a little bit, just like some of the other emerging markets, into India also. And India, one of the advantage of India is that there are some high quality companies that some of these global investors look at. Even from a global perspective, whatever happens in macro, there are a few high quality companies in India which are like world class in terms of their operations or their disclosures, their governance, and their long-term track record of performing. And I've seen, I'll just give you one data point. In last 21 years, 18 out of last 21 years, foreign investors have been a net positive investor in India. There are political elections and there are ups and downs in India. Rates go up, rates go down, profits go up, profits go down. But there is a certain attraction about India among foreign investors because one, there's a long-term macro story. And the second is a micro story that always there are certain good companies to invest for a global investors who look at all the markets. Now, what will happen going forward? I go back to my earlier point. I think for you to turn very bullish on emerging markets, keep a watch on three things. The US Treasury yield should stop falling. US dollar should stop appreciating. Little bit of weakening of US dollar and US Treasuries. And stabilization in the commodity prices will be good for EM and will be good for India also.
Thank you. Now, I think there are a lot of questions that are coming on sectors. So I will briefly touch upon some of the questions on those in this aspect as well. A lot of questions are coming in terms of how do you see the banking sector, both the private and public sector banks. There is a perception that NPAs may start going up in the near term. And also, a related question in terms of the NBFCs also, in terms of what sort of would you expect some pain coming in the near term, and can you look at the sector as a whole and give your comments?
Yes. No, thanks for asking that, and that's a great question because it has been like the epicenter of a lot of discussions in India, just like a lot of other parts of the world. So in banking sector, even before this crisis, I think over the last few years, a lot of progress had happened on IBC, on resolution of the NPAs, etc. But now this crisis has brought in another challenge. Retail side was doing well. Now there is a bit of uncertainty what happens to even the retail lending. We have gone through a lot of pain on the corporate lending, but that started improving with all the resolutions and the banks getting recapitalization, etc. But now this crisis has led to like a lot of uncertainty and unpredictability on what kind of credit cost can come in the banking sector. We had some challenges in the NBFC and HFC sector even before this crisis, right from when the ILFS defaulted in September 18, and then a couple of NBFCs, HFCs defaulted. That sector was already kind of in a degrowth mode, or was kind of preparing for a new normal. Now again, a new challenge has come for them. What RBI is trying to do as much as possible is to ensure that financial system doesn't get into another trouble, and that's why so much of liquidity pumping in, giving the moratorium, allowing them to do some bit of restructuring, particularly for the real estate, etc. But the point that I made earlier, between the government and RBI, they will have to do a lot more. There needs to be maybe a fund which provides maybe an equity capital or some kind of a bond capital into some of these NBFCs, HFCs. Otherwise, they will surely face some challenges in next 2 quarters if the pain on the health crisis deepens, if the lockdown continues. So I think there are certain amount of challenges in the financial sector, which is also reflecting in the market. BankX has taken the biggest brunt of the fall so far, but BankX was like the best performer also earlier. So obviously, in an economic crisis, they had to take the biggest fall. But we have to keep one thing in mind as an investor. From a structural long-term perspective, formalization of the economy, financialization of the economy, digitalization of the economy, India is underpenetrated both on the credit side as well as on the savings, investment, protection product perspective. There is a lot of opportunities. Banks, NBFCs, HFCs, banks or non-banks, wherever there is good amount of capital available, good liability side, assets are granular, risk management, and strong digital assets, they will come out stronger because there is going to be a lot of consolidation in the sector. And I think bet on some of those names, but be very selective, because valuations for the near term will remain depressed. We will not go back to the valuations that we had where some of the banks were at 4 times price to book plus, and NBFCs at even 7, 8, 10 times price to book. That will take a lot of time because we don't know how much credit damage will happen in the next few months. So you have to be cautious and take your picks very, very cautiously.
Thank you for those clarifications. I think from an NRI perspective, we get this question almost every time is on the real estate sector space, even though we read a lot in terms of there is challenges on, especially on the commercial side going forward. How do you look at the residential side, the availability, whether there would be price corrections that would come in the near future? Can you please give your views on that?
So commercial real estate has been doing well in India for the last few years because the supply didn't come much post 2008. And in fact, the commercial project, the builders moved, even those who were doing the commercial projects converted into residential because residential was doing well in next few years. And now there is more like oversupply in the residential side. Commercial supply has been absorbed by large investors like Blackstone, etc. over the last several years. And a lot of global pension fund, global sovereign wealth fund have been a very big investor, including the likes of your RDR, GIC, etc. Large investor in commercial real estate, and that has done well. Now, of course, after this crisis with companies talking about work from home, etc., my view is that the large format commercial real estate will have some pain because companies will be a little cautious of putting 10 or 20,000 people in one single office. But actually, or maybe even the co-sharing, etc., will be in trouble because people will feel cautious about going to a place where there are hundreds or thousands of other people. My view is actually other way around. Commercial real estate in smaller offices actually will do well because a company will think, I don't want to have 5,000 people in one single office in a large city. I want to have 10 offices in the city where I have maybe a few hundred or tens of people, so that, because completely 100% work from home is also not going to work. I think reality will be somewhere in between. So I see actually an opportunity in micro level like commercial real estate. On the residential side, I think we are going to have a decent price correction. There has been a huge time correction over the last several years. Prices have been like sideways to little lower. Now they will fall because a lot of builders will not find it easier to survive. And with that price correction, the cheaper money, lower mortgage rates will generate interest in the residential real estate also. So I think it won't be a bad idea. Keep a watch on the real estate over the next few months. I'll go back to my earlier point. With lower rates, financial repression, there will be interest in real assets. We talked briefly about gold. I think a point will come where people will say, why not even real estate? Because I mean, the other asset classes, particularly bonds, are looking richly valued at some point in time. And if equities go up, there will be interest in real estate also.
Thank you. There is some questions in terms of the markets, the way it has been behaving. You found in the month of April, some of the stocks have recovered 40 to 50%. Some sectors like FMCG, ITs, we have seen strong rebounds in pharma sector especially. And we also know that corporate performance in 2021 is not going to be as great, or it may even go down before lower than what it was in 1920. So from a fund manager perspective or an investment perspective, how do you think fund managers are going to approach investment or stock picking in the near term or going forward to give returns to investors?
Sure. So at our end, I mean, so you're right. I mean, there has been a big bounce back from the low levels, particular sectors that you talked about, healthcare, FMCG and all. I mean, actually, the market is all over the place. And, you know, while Nifty is at 9,200, 9,300, you have stocks which are close to an all-time high. I mean, they are where the Nifty was 12,000. There are stocks which are trading lower than where they were even in 2013, when Nifty was like less than 5,000 and this rally started. So market is like all over the place, and I'm talking about like even the large caps within that, and it's the same thing is there in the mid and small cap. I think you have to look at each individual stock in isolation and see the way we think about investing is you have to buy a great company, great management, reasonable valuation. Today, across sectors, there are a lot of stocks which are good business from a long-term perspective. Nobody really knows about the short run by good management, and the valuations are also reasonable. Market is very smart. Wherever there is not much of damage in the very near term, balance sheets are good. I mean, you talked about consumer staples, but the valuations are already reflecting. Several of them are trading at like 50, 60, 70 times price to earnings. Of course, they will do well in the near term. There is no damage on their balance sheet. And there are businesses where people are the complete uncertainty. You don't know whether a hotel will start in next 6 months or 1 year or 2 years. But I know one thing, there are everybody will discuss so much. I do so many of these webinars on the new normal, what will change in the world. There are few things will not change in the world. Me and you, there is something in our DNA to go and meet in person, to go and do events, to look good, to go around. That will not change. And several businesses, I think of those which are getting impacted today, ultimately will come back. But within them, large number of weaker players will go out of the business. Take example of, let's say, hotel industry. I mean, large number of weaker players will go out of the business. Nobody next 2 or 3 years is going to put up even a single room. And that after 2 or 3 years, when world comes back to normalcy, even with all the virtual work, people will have their marriages and events and weddings and variety of things. And then maybe the survivors will do well. All you have to ensure is whether the balance sheet can survive next 1 year, next 2 year, next 3 year. And then look at the value. That's how I'll be looking at, not so much of sector view, but that's how I will be looking at the stocks. We can discuss more in details in sector, but I think that's more critical than taking some top-down view, because market is smart. I mean, wherever there is a lesser damage in the near term, more certainty, I mean, stocks are already trading at a higher valuation.
There are a few concerns in terms of some of the mid caps and small caps have corrected quite sharply. So where do you see this sector or this segment of the small cap and mid caps performing in the near term, or should investors look at it even at this point of time?
You know what? So, I mean, our small cap fund was like closed for subscription for 4 years, right? Since like 15, 16, when small caps started going up, because there's less liquidity in the small cap space. We didn't want too much of money to be managed in a small cap fund. We closed it. Then we opened it only for SIP, small amount of SIP, not much. Now we just opened it a month back. And what is the thought process behind it? We are entering a world where there are going to be a lot of disruptions. Disruption in consumer behavior, disruption in policy, disruption in technology, digital disruption in all factor market, disruptions in logistics, so on and so forth. I can go on. Now in that case, it's not about whether you are a large or a small. In fact, for some of the larger size companies, problems are going to be larger. For a smaller size company, who would have thought out of nowhere a Zoom will become a $30-40 billion company? I mean, nobody even knew about Zoom, I mean, till 2 months back. and what they have become in a short period of time. And in every sector, there are going to be Zoom kind of opportunities. If you are a smaller player, if you are nimble, if you are agile, if you can adapt to this new world, which we are getting into, there could be a massive opportunity because you don't have the legacy of, and then, this size gives you a lot of stability, but size gives you bureaucracy, size gives you rigidity, size gives you not an ability to unlearn. And a smaller guy can do that. So smaller guys will be in trouble if there's a problem in the balance sheet and they cannot survive. But if a smaller guy, balance sheet in a good shape, management is good, there's going to be opportunities. I'm not looking at large cap, mid cap, small cap. We are looking at as a team on where there is an opportunity to bounce back after a year or two.
Yeah, thank you very much, sir. The last question, which I kept it for the last, was on the recent debt market fiasco that happened with one of the fund houses in India. And so there have been a lot of questions and concerns in terms of how is the fund industry equipped for this, or are we going to see any sort of situation like that happening once these papers come for maturity in the near, let's say, 3 to 6 months time. So please, can you share your views to assuage the feelings of the investors who are looking at putting money in the debt funds as well?
Sure. So, there are 2 or 3 ways to look at it. Number one, that there are different kinds of funds. Just like, there are different kinds of organizations, there are different kinds of funds, there are different kinds of strategies. A particular strategy which was based on taking higher credit risk and then keep delivering high return over a period of time, maybe in a normalized scenario, did very well for a very, very long period of time. But of course, the way over the last couple of quarters, the slowdown in the economy, and then of course one after another event, particularly after the IL&FS crisis, whether in the real estate sector, whether with several promoters, what happened in several loan against shares, whether in the NBFC, HFC sector, so on and so forth, led to a large part of the industry becoming very cautious on the credit side. At our end, we have always been, even before the IL&FS crisis, we look at our portfolios, but I don't want to use this as an opportunity to talk about our fund philosophy or maybe our funds, but I will keep it more generalized. I think the IL&FS crisis gave a good opportunity to the industry to have a relook at the overall credit exposures. In last 1.5 years, just to give you one number, the peak exposure of mutual funds to NBFCs and HFC was like 4.5 lakh crores. In last 1.5 years, now it has come down below 2.5 lakh crores. A huge amount of maturities has already happened. The amount of money that industry had in some of these promoter funding, loan against shares, I think was very large amount, has come to very, very few hundred crore, maybe few thousand crores, significantly increased because all of these promoters went offshore to borrow money rather than relying on the mutual funds. A lot of promoters or companies who had a huge reliance on the commercial paper market, etc., borrowing short-term, lending long-term, they all got their lesson after the IL&FS crisis. They have reduced their reliance, so on and so forth. So overall, from an industry perspective, portfolios became better rather than what they were maybe 1.5 years back. But there were few funds which were positioned for that high risk, high return. And the way markets got frozen, of course, they had to pay a price for it, but don't generalize it to the overall industry. I think people have taken the right steps. Regulators have taken the right step, particularly credit to RBI. They immediately, after the closure of those 6 funds, they announced this refinance window to the mutual funds. Now, the only thing that should give you good confidence about the industry is that after that 50,000 crores of window announcement, the money that has been borrowed by the mutual fund is not even 10% of that. That just shows that it's not that every mutual fund is borrowing money and every mutual fund is seeing redemption, that they have run out of liquidity. Not really, because for the kind of credits we have in our portfolio, we are not seeing any credit crisis, and we have not borrowed any money from banks or from RBI. In turn, refinance from RBI by those banks, etc. So reasonably, I'll also put it in a different context about two perspectives that everybody should keep in mind. Number one, and I've mentioned it on a couple of platforms. In a $3 trillion economy, we were supposed to become almost 3 trillion now, of course, with the rupee depreciation and all, we may be smaller. In a $3 trillion economy, a $3 billion fund had to shut down, has also kind of given a moment for everybody, including the policymakers and everybody, to think about the liquidity in India's bond market. And to me, I've lived through 91 crisis of India and 92 scam in the capital market, and how it led to SEBI and mutual fund regulation, online trading of NSE, depository, and all kinds of things, dematerialization and the derivatives market, deepening of bond market, corporate governance, so on and so forth. I think this will be that moment which will give an opportunity to the policymakers that we need to bring in next generation of financial sector reforms in India, deepening of the bond market, deepening of securitization market, lender of last resort, so on and so forth. And I think next few years, if all of that happens, it will give you an opportunity to look at India's credit markets also. That's what I mentioned earlier. Not in the format like you put money in a T+1 liability mutual fund, which is taking a lot of illiquid assets. That's not the right way to do it. We never played it. But in an AI format, there could be interesting opportunity. You will get credits giving you 12, 13, 15, even 20% returns, and now rupee is depreciated, may depreciate a little more. Those kind of returns with good kind of collateral, good kind of covenants, good kind of assets, and now you have the IBC, etc. So even if something goes wrong with the promoter, you know that asset belongs to you and you can recover your money. There are going to be interesting opportunity on the credit market. So rather than saying, boss, we have seen this moment and there's no point investing, I think there could be, after a few months, there could be interesting opportunity even on the credit markets in India. That's how I will look at it.
Thank you very much, Mr. Navneet, for addressing a whole range of issues, from equities to alternatives to the debt markets and what investors should be doing in terms of asset allocation. I will now call upon Mr. KV Shamsuddin, our director, to formally propose a vote of thanks on behalf of Barjeel Geojit Financial Services.
I'll just take
sure.
1 minute for a last comment that, I mean, the Dubai and the Middle East has shown to the world, parts of Middle East, that in a desert where there's not even a water, and the kind of weather it is there, and what kind of world it has built over the years with the hard work, and a lot of that hard work is of the people who've gone from India. What, a community and a society and economy that we have built over the years, despite so many constraints. And I think given the constraint that the world is today, so many interesting innovations are likely to happen. Next 2 months, we have to stay safe, stay healthy, take care of each other. But the world that will come after a year or two will actually going to be more beautiful than what people are fearful. So dark clouds always get followed by a shining sun. This time won't be any different. We don't know how dark they are going to get in next few months, but ultimately a shining sun is likely to come, and keep that faith in the human ingenuity. Thank you so much.
Thank you for that optimism, Mr. Navneet. I now request Mr. Shamsuddin to formally propose a vote of thanks. Mr. Shamsuddin.
Namaskar.
Good to see you.
How are you?
Good to see you.
Yeah. In fact, you had given a wonderful picture of Indian market and the international scenario. People were so much of worried about what was going to happen to the market and all. And you have given a lot of confidence to the investors. And I'm very happy to see your, listen to your presentation. And we have a lot of questions, in fact. But most of the questions already you covered in your presentation. It is a golden opportunity for our clients. In fact, in one point of time, we have more than 420 attendees present for this webinar. And on behalf of all the attendees, as well as from Barjeel, we express our sincere thanks for making a wonderful presentation and give a lot of hope on Indian capital market. That is the most important. And people are making money also. That is the most important, I can tell to our customers. Those who are keeping aside by fearing, they are losing opportunity. There are people aggressively making use of the market fluctuation. Current last 2 months, they are making a good money. That is a very interesting point. I can tell all our respected clients. And once again, I express my thanks to Mr. Navneet Munot and Mr. Nitin Safre and all the attendees for making this webinar success.
In the last 25 years, the returns on various financial asset classes like bank deposit, gold, and real estate have multiplied several times. But there are a few select investments in the Indian capital markets that have had the potential to appreciate exponentially over 100 times. If you had known this at the right time, you would have taken the right investment decision. which is precisely why you need an expert's validated advice when it comes to investing. Welcome to Barjeel, one of the few SCA-approved financial intermediaries in UAE. We are wealth builders, guiding customers since 2001. We have serviced over thousands of them till date, and today we cater to large segments across investor groups. This speaks about our enormous goodwill and their undiluted trust. And we have earned that trust by telling, not selling. We educate you on the investment opportunities that are ideal for you. We then help you make an informed decision, impartial and unbiased, keeping your long-term goals in mind. And with us, everything is long-term, be it commitment, relationships or success. We offer comprehensive insights across a wide range of products through a holistic approach. We ask you the most important questions, the answers to which will help you focus on your investment objectives. For example, you work for over 30 years. Are you saving enough for the next 30 years? For life goals like children's education, your daughter's wedding, or your retirement. Think about it. You work hard to earn your money. Does your money work hard enough for you? Barjeel, let's build your future. Come, let's talk.